who want an exposure to a market or an
Everything they need in one place.
Be the world's foremost authority on
Individuals, advisors and institutions. Hello and welcome to Morningstar. I'm Emma Wall, and here with me today to give his 3 financial stock tips is Guy de Blonay, manager of the Jupiter Financial Opportunities Fund. Hello, Guy.
Thank you, Emma.
So what's your first financial stock?
The first one would be a peripheral Europe stock to be found in Italy called Unicredito. I think the opportunity here is at different levels. The first one is the recovery of the periphery. So the risk premium reduction, the restructuring story that this stock offers in selling non-core assets, repositioning the companies into countries it feels comfortable with, and the Italian domestic recovery as well, with, as you probably saw, the latest developments in politics, where a new potential prime minister taking over that has much better plans for reforms, but also the valuation of peripheral Europe in general, but very much Unicredito as an example, with deep discount to its book value. So you could believe in a normalization that could, a normalization of profits that could ultimately, if capital ratios are adequate and the regulator's happy with it, that this company could see its discount narrow towards its book value, and that could offer some decent upside.
Of course, people will hear Italy and hear banking and they'll think risk. We know about the Spanish banking sector. There's been a lot of consolidation there, which has sort of reduced risk. How risky is an Italian banking stock?
Well, it's true that the fear in the past has been towards, I suppose, provision levels not being adequate. But I think the very positive sentiment that is surrounding peripheral Europe is the commitment from the ECB, Mario Draghi, to do whatever it takes to keep these countries afloat, but very much enable them to benefit from a lower cost of borrowing. And I think that will enable these economies to start to actually grow again, the likes of Spain, but Greece as well, and Portugal, and very much Italy. Not that much. Perhaps Italy will grow probably for the next 3 years about 1%, but that's more than that's positive, and it's clearly keeping the bears away from the deflationary potential scenario that many are pushing forward to believe. So I think the provision might actually be adequate as the economy recovers and that non-performing loans starts to reduce.
And what's your second stock?
The second stock would be a growth stock called MasterCard, a company that is at the forefront or very much in the middle of benefiting from a cash-to-cashless economy. So we're spending more and more over the internet through networks such as credit card networks, Visa, MasterCard, American Express, or PayPal, for those who knows eBay or have been using their payment processors. So the idea here is that more and more on a global basis or the middle class is growing quite fast, and more of us are using networks to or their credit card to or the internet to buy Christmas presents, groceries to be delivered at home, books, DVDs, and also even watching films on demand at home. So the cash migrations from cash to cashless economy is not a question of if, but a question of how long it will take for most of us on the globe to start to do it. And I think to be involved in a company that has such a secular growth story, such as MasterCard, it is an opportunity for us to offer in our fund an exposure to that growth.
And what's your third stock?
The third stock would be obviously Lloyd's. Lloyd's, I think, is, we've talked about it, it's an interesting a company because it has shown that restructuring stories from very early on, as managements are repositioning a company after change in management, new management repositions the company towards what it does best in its core market, gets rid of exposures that are seen as non-core, focuses on profitability rather than revenue growth, so doesn't spend stupid money to chase growth, but very much retrench, cut cost, and produce profitability that can give some can provide investors with capital return. But then instead, once the earnings power is returning to normal, use a portion of that earnings not to fund irrational growth, but very much give it back to shareholders to enable the story to have a second phase and become a dividend play rather than simply a restructuring play. So we've been with Lloyds from a restructuring story to now a potential dividend play that will very much attract a large portion of investors in the UK to start with.
Keith, thank you very much.
Thank you, Emma.
This is Emma Wall from Morningstar. Thank you for watching.